Managing taxes on retirement income from multiple sources can feel like juggling a lot of moving parts. If you're an American retiree with income coming from Social Security, pensions, 401ks, IRAs, or even investment accounts, this process can get complicated fast. But don't worry, by the end of this video, you'll have a clear understanding of how to manage taxes on your retirement income and how some strategies can help you keep more of what you've earned. Before we dive in, if you're serious about protecting your wealth in the next 2 weeks, I recommend clicking the first link in the description to get a free guide on why thousands of Americans are opening gold IRAs to safeguard their savings. This strategy has been a game changer for many retirees, and I'll explain more as we go. So, how do taxes work on retirement income from multiple sources? The key is understanding how each type of income is taxed and finding ways to minimize that tax burden. Let's start with Social Security. Did you know that up to 85% of your Social Security benefits can be taxed? It depends on your total income, including withdrawals from retirement accounts like 401ks or IRAs. The more income you pull from other sources, the higher the portion of your Social Security that could be taxed. This is where tax planning becomes essential. One effective strategy is managing the timing of your withdrawals. For instance, taking too much out of your IRA in a single year could push you into a higher tax bracket, making more of your Social Security benefits taxable. A well-timed smaller withdrawal can keep you in a lower tax bracket, helping you save money on taxes. Next, let's talk about pension income. While pension payments are generally taxed as ordinary income, the tax impact varies depending on how the pension was funded. If you contributed to your pension plan with after-tax dollars, you might have a tax-free return of those contributions, but the rest is taxable. It's important to understand exactly how your pension works to avoid any surprises. Now, what about your 401k or IRA withdrawals? These are typically taxed as ordinary income. For many retirees, this becomes a significant part of their overall income. But here's where a gold IRA can come into play. By rolling over part of your IRA into a gold IRA, you can potentially reduce some of your tax burden. Gold IRAs allow your investments to grow without triggering taxes until you withdraw, giving you more flexibility in how and when you take distributions. But it's not just about the tax deferral benefits. There's the added security of diversifying into a tangible asset like gold, which has historically held its value better than many other assets during times of market volatility. If you're looking to protect your wealth in a rapidly changing economy, a gold IRA might be the solution. Let's also not forget about dividends and investment income from stocks or bonds. These are usually taxed at either regular income rates or the lower long-term capital gains rates, depending on how long you've held the asset. If you have investment income from various sources, it's important to plan how much you're withdrawing each year to avoid triggering higher taxes. One option could be spreading your withdrawals over multiple years to keep your taxable income at a manageable level. Speaking of managing taxable income, the last thing you should consider is your required minimum distributions, or RMDs. If you have a 401k or traditional IRA, the government requires you to begin taking distributions at age 73. These mandatory withdrawals are taxable, so understanding how they fit into your overall tax strategy is key to minimizing your tax liability. Some retirees choose to convert a portion of their IRA to a Roth IRA before RMDs kick in, because Roth IRAs aren't subject to RMDs, and withdrawals from them are tax-free. Ultimately, it's all about balancing your income sources, understanding the tax implications, and making strategic withdrawals. Now, if you're wondering how to optimize all of this to make sure you're not overpaying in taxes, the best place to start is by working with a tax professional who understands retirement accounts and tax laws. But if you're looking to take control of your retirement savings and make your money work harder for you, opening a gold IRA could be the right move. It's especially useful for retirees with 100K or more in their IRA or 401K, or even those with 5 million or more in savings. Don't let your wealth sit there at risk. It's time to take action and protect it. Click the link in the description to learn more and get your free guide today.